Okay, so it is Friday, February 27, 2026. The closing bell just rang on the New York Stock Exchange.
And we are looking at some very interesting numbers.
We really are. If you've been, glued to the ticker today like I have, you saw that IonQ closed the week at exactly $41.30.
Right, which is a price point that tells well, a pretty complicated story right now.
It definitely does, because if you think about where we were even just a couple of years ago, we talked about quantum computing like it was this perpetual science fair project.
Always 10 years away.
Exactly, always just around the corner. But looking at the stack of earnings calls and geopolitical briefs on the desk for this deep dive, that narrative has completely shifted.
It really has. We're looking at an industrial reality now.
Yeah, and that's the core of what we're unpacking today, the shift from a research lab mentality to an actual viable business model.
Which requires two very different sets of skills. Proving the physics is one thing. Proving the business is another entirely.
So our mission today is to figure out if this company is just burning through cash, and we will definitely get to that burn rate later.
Oh, absolutely.
Or if they are actually building what analysts are calling a toll bridge for the future of computing.
Right, something so essential that they just become unassailable.
Exactly. We're stripping away the sci-fi quantum hype to look at the moat, the management, and the actual numbers.
Sounds like a plan.
Let's jump in. Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, Business Understanding.
So, I think we first need to define what IonQ actually is in 2026. Because people probably still picture folks in lab coats tweaking lasers.
Yeah, in some university basement in Maryland.
Right. But the source material makes it clear that's outdated. They are a full-stack platform now.
Meaning they aren't just doing research, they control the whole vertical, from the atomic level of the chip all the way up to the cloud interface you'd actually use.
And they have real revenue streams now, two main ones, right?
Yes, the revenue mix has matured a lot. First, you have QCaaS.
Quantum computing as a service.
Exactly. It's the utility model. They partner with AWS, Azure, Google Cloud. You don't buy the quantum computer, you just pay to use its processing power via the cloud.
It's like renting a supercomputer by the second.
Right. It's a high-margin bridge that lets pharmaceutical companies or banks access the tech without owning it.
But the second stream is what really took off in 2025, direct sales.
Yeah, selling the actual hardware. Systems like the Area, Forte, and the upcoming Tempo. And these are going to sovereign governments and massive research institutions.
Sovereign sales. Like the Romania project in our notes?
Rota QCI.
Right, the Romania National Quantum Communication Infrastructure.
It's a mouthful, but it's one of the largest quantum key distribution networks outside of China. It proves the tech is scaling to national infrastructure levels.
Which is largely a security play for unhackable networks.
Exactly. But to understand why Romania chose them, we have to look at their secret sauce, the tech differentiator.
Because they're competing with giants, IBM, Google, but they're taking a totally different road.
Right. The big guys mostly use superconducting qubits.
Which means massive dilution refrigerators. Right?
Huge, expensive, room-size refrigerators to chill man-made circuits to near absolute zero. It's a logistical nightmare to scale.
And IonQ doesn't do that. They use trapped ions.
Individual atoms of ytterbium or barium suspended in a vacuum. The reports call them nature's perfect qubits.
Nature's perfect qubits. I love that phrasing. Because every atom is already perfectly identical. You don't have to manufacture them.
Nature did the quality control for you, which leads to incredible performance. Late 2025, they hit 99.99% two-qubit gate fidelity.
Okay, let's translate that. What does 99.99% fidelity actually mean?
It means they hit the critical threshold for error correction. Quantum systems are naturally noisy, they make mistakes.
Right.
But once you hit that 4 nines reliability, you can run error correction that actually works. The system becomes reliable enough for commercial use.
Not just theoretical math, and it's way cheaper too. The notes mention a semiconductor-based roadmap.
This is their huge cost advantage. They use standard chip manufacturing, which makes their systems about 30 times cheaper than those rival refrigerator-sized machines.
30 times. That is a massive disruption. Which brings us to the people actually executing this.
Chapter 2, Management Evaluation.
So steering the ship, we have Niccolo de Masi as CEO. And he is not your typical quantum physicist.
And that's exactly what they need right now. He's an operator. Yes, he has a physics background from Cambridge, but his career is all about scaling public companies and doing complex M&A.
He's focused on the business side. And he brought in Inder Singh as CFO and COO who came from ARM Limited.
That is a crucial detail. ARM designs the architecture for basically every smartphone chip. Singh wants IonQ to be the arm of quantum.
The standard architecture everyone else builds on.
Exactly.
And they are being so aggressive with their capital to make this happen. They have this massive war chest.
Which they used for the $1.8 billion acquisition of Skywater Technology.
A foundry, which is a huge bet. Why not just outsource the manufacturing to TSMC or someone like Apple does? Why buy the whole factory?
Supply chain security. Think back to 2025. The disruptions, the tariffs. If they rely on external suppliers, they are incredibly vulnerable.
So they bought a trusted Category 1A foundry.
Right. They own the foundry now. They don't have to wait in line. They control their destiny.
Plus, they picked up Oxford Ionics and Vector Atomic.
It's all about owning the vertical monopoly. They are sacrificing short-term cash for long-term dominance.
And to their credit, they are delivering. They keep hitting their hashtag AQ targets early.
Algorithmic qubits. It's their processing benchmark. Hitting AQ64 ahead of schedule shows incredible transparency and execution.
But all of this ambition comes with a very real price tag.
Chapter 3, Financial Health.
Okay, let's look at the numbers. 2025 was framed as an inflection point.
It was. Revenue hit $130.0 million. That's up 202% year over year.
First time over 100 million. That's serious growth.
And their remaining performance obligation. The backlog of contractually guaranteed money is sitting at $370 million.
So they have great visibility into future revenue, but with these companies, we have to talk about the net loss.
The scary number.
$510.4 million in 2025. Over $500 million.
It sounds terrifying, but context is everything here. A massive chunk of that is stock-based compensation.
Which dilutes shareholders, sure, but it's not cash going out the door.
Right, and more importantly, R&D spending increased by 123%.
They are pouring it back into the lab.
Because quantum is a winner-take-all market. R&D is not an expense here. It's a survival investment. If they stop spending, China or IBM wins.
Good thing they have the cash to support it.
Oh, they have a mountain of it. A $3.3 billion cash pile, thanks to that $2 billion equity offering.
$3.3 billion. That gives them a current ratio of 15.5x.
Meaning for every dollar of near-term debt, they have $15.50 in the bank. They have an incredible runway. They don't need the capital markets right now.
Which is huge. But let's look at valuation. The price-to-sales ratio is around 109x.
It's undeniably high. But when revenue is growing at 202%, that multiple compresses very fast.
And the educational discounted cash flow models in our sources tell a different story.
Yeah, they suggest a fair value median near $72.50.
And again, the stock is at $41.30. So the models say it's severely undervalued, even with the high PS ratio.
Exactly. The market is weighing the risk. The models are projecting the monopoly.
All right, so that's the internal picture. Let's see how the rest of the world is reacting to all this.
Part 2, chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
So looking at the chart, it is definitely a tug-of-war right now.
Yeah, technically the stock looks oversold. It's trading below its 50-day average of $44.40 and below its 200-day. It's just kind of stuck.
And the skeptics are very loud. Short interest is massive. Roughly 23.8% of the float.
That's 82 million shares actively betting against the company. Where is that skepticism coming from?
A few places. There was that Wolfpack Research short seller report in late 2025. Plus, people are nervous about the Skywater integration.
Swallowing a $1.8 billion manufacturing plant is not easy.
Exactly. And quantum has a history of broken promises, so some investors just doubt the timeline entirely.
But the analyst community isn't universally bearish?
Not at all. You have the bulls, like Rosenblatt, with a $100 price target. They look at the defense contracts and sovereign sales and see a future monopoly.
But then you have Morgan Stanley on the other side.
Right, with a $35 target. They're looking at that $500 million loss and worrying about the volatility and when this thing will actually turn a profit.
Though you have to admit, growing revenue by 202% is a pretty solid rebuttal to anyone calling the company stagnant.
It is. The fundamental business is executing, even if the stock is taking a breather.
Which makes me wonder who is actually holding the stock right now.
Chapter 5, ownership structure.
Is it just retail traders, or is the smart money getting involved?
This is a huge point for the bull case. The smart money is definitely accumulating. Vanguard increased their stake to 9.8%. And BlackRock is up to 8.5%.
And Morgan Stanley Investment Management holds a large chunk too, right? Despite their own analyst having a $35 target.
Exactly. The investment arm operates independently from the analysts. But But seeing these massive institutions buy-in shows, they view this as a real industry, not a science experiment.
But what about the insiders? Because I remember seeing a headline about the executive chair, Peter Chapman, selling a ton of stock.
Yeah, about $171 million worth.
Which sounds terrible. It sounds like the captain is fleeing the ship.
Headlines love to frame it that way, but it requires context. This was a pre-planned 10b5-1 trading plan.
Meaning he set the schedule to sell way in advance. He didn't just panic sell on a random Tuesday.
Right. It's standard diversification for founders. He still holds substantial shares and options.
So the institutional buying is really the stronger signal here.
Chapter 6. Risk assessment.
Okay, we can't do a deep dive without looking at the threats. We know the strengths, incredible tech, $3.3 billion in cash. We know the weakness, the massive cash burn. But what about external threats?
The geopolitical race is the biggest one. The race against China.
If a rival nation figures out quantum error correction first?
Then IonQ's commercial lead basically vanishes overnight. The second-place prize in this industry could very well be zero.
Wow. And what about the tariffs? The 2025 tariffs seem like a boring policy thing, but they hit this industry hard.
Very hard. Tariffs on components from China, Japan, and the Netherlands drove up the costs of lasers and cryogenics by 20 to 35%,
So every machine IonQ builds is suddenly way more expensive,
putting huge pressure on their hardware margins.
which circles right back to why they bought the Skywater foundry, to build it domestically and avoid the tariffs.
Exactly. But that brings its own risk. Integration risk.
Right, merging a nimble tech lab with a heavy manufacturing foundry.
It's a $1.8 billion task. If they suffer from corporate indigestion or execution failure, their whole roadmap gets derailed.
Chapter 7. Conclusion.
So we're really at a pivot point with this company.
We are. The bull case is clear. Tripling revenue, the best tech with trapped ions, and enough cash to survive the valley of death.
And the bear case is the cash burn, the dilution, and the manufacturing risks.
But I keep coming back to the toll bridge metaphor.
Yeah, explain how that applies here with something like the Romania network.
Think about the switching costs. Once IonQ builds a nation's secure networking and computing infrastructure, that nation is locked in.
You can't just unplug your national security apparatus and switch to a competitor to save a few bucks.
Right. Once they lay the rails, they own the network.
So for an investor looking at the stock at $41.30 today,
It's a neutral entry point. There is no traditional margin of safety because there are no earnings. But if the roadmap holds to 2030, the upside is simply massive.
here's a final thought for you to mull over. For years, the question was simply, will quantum computing actually work?
And we know now that it does. Right. So maybe the real question for IonQ isn't about the physics anymore. It's about manufacturing. Can they build the chips fast enough to outrun the geopolitical tensions and tariff wars of 2026?
Because the technology is ready, but the global stage is only getting more complicated.
That is the multi-billion-dollar question. Thanks for joining us for this deep dive.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.